Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right, hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, we are going to be talking about inflation.
Inflation. You know, I get lightheaded every time I think about inflation. I just can't think about all the times I have to blow up the balloons for all my kids' birthday parties. I do not like inflation.
Okay, so it's getting hot, right?
Yes, it's warm outside.
My wife sent me a picture that she's at her parents' with our daughter playing in the little kiddie pool, which is inflatable.
Yep.
And she's like, well, my air compressor's broke at my house.
Oh, no.
So she's like, do we need to borrow my dad's air compressor to do this? And I was like, well, if you want to use it now, yes, because I haven't fixed that. So otherwise, I would have been inflating an entire kiddie pool with my head.
Yes.
And, that sounds like brain cells
I
lost.
have one you can borrow if you need.
Yeah, well, I appreciate that, Josh. You're a good guy. So, yeah, we're going to be talking
full
about
a lot of hot air, so I can help you.
Maybe I'll just have you do it for me.
That's right.
So, inflation, Josh.
Yes.
It is kind of the topic that everyone's talking about.
Yep.
It's
You see it
freaking
on the
people
news,
out. It's
see
all
it
over the
everywhere.
news.
Yep.
Seems like it could be the end of the world. Let's just talk about it today.
Let's start high level like you like to do.
Ooh,
Like to get up
50,000
there,
feet.
Way in the air. Give me the definition.
That's right.
What is
So-
inflation?
Inflation, as defined by Investopedia, our friends, which don't sponsor this show, but if they wanted
But
to,
if you Google it, you
hey,
always get an answer
they
from
could
them.
reach out. We would totally talk to them. But
I think they're a
inflation,
nonprofit that survives solely on everybody else putting their own stuff in. So
no, everyone just takes all their data off of their website and doesn't ever give them credit. So we're at least giving them credit. So inflation is the decline of purchasing power of a given currency over time. A quantitative estimate of the rate at which the decline of purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time.
okay, that was useless. So can you put that in normal Josh Robb terms for me, please?
So Josh, you were living in Findlay.
Yep.
That's what we do. You go to Fort Findlay Donuts,
Best place in the world.
best place in the world, and you get yourself a maple bacon fritter. It's probably not your favorite, but it's my favorite.
It's a good donut.
So you get yourself a maple bacon fritter, and it costs $1.
Yep.
Hypothetical. They're a little bit more than that in real life. That donut costs you $1 today. Next year, on whatever day we're recording this, plus 1 year,
Yes.
T plus 365.
Yep.
You go buy that same donut,
Same donut.
and
same
that
store.
same donut at the same store costs $1.10.
Oh man.
So that 10 cents increase that's inflation. That's what's happening. It's the increase of price over the past year. And actually what that means is that your $1 used to buy one donut. Now your $1 does not buy a whole donut. So that's the decrease in purchasing power of that $1.
All right. So I got a little distracted there. You mentioned donut. Started daydreaming.
I would eat one.
Declining of purchasing power.
Yeah.
Is purchasing power.
Yep.
That sounds like a superhero. Is that like one of the kids from Captain Planet? Is that right? You got Earth,
I don't
fire,
know what-
wind, fire, purchasing power.
What is Captain Planet?
You don't know Captain Planet?
No, but
Oh, my
Earth,
goodness.
Wind and Fire was a band in the 70s.
Yeah. Each of these kids had a ring, and they had an element, and when they all combined, they created Captain Planet.
See, I'm not allowed to watch witchcraft like
man.
that.
It was the best. Although the one kid had heart, which just kind of seemed like
That's not a great superpower.
I mean, what do you do with that?
You got heart, kid.
Like each other?
You got heart.
So, what is that?
Yeah.
What is,
So in general, it's just saying your dollar can't buy that whole donut anymore. It's not as powerful of a dollar as it used to be last year, and that's what inflation is. So it makes you use more dollars to buy the same things over a certain period of time.
okay.
So the flip side of that
Yeah.
is I was going to mention is deflation. Mm-hmm. So suppose, Josh, you go to the same donut shop, Fort Findlay, what
Yes.
up? And you get your $1 maple bacon fritter. You enjoy it. It's delicious. You get 2 sittings out of it because those things are kind of giant and they're really rich.
You might, but
But then you go back, T plus 365, one more year.
yep.
And it costs only 90 cents.
Ooh, boy.
That's a deal, right?
Yeah. No
So-
coupon, just cheaper.
That's actually called deflation. It's a bit more rare, and it sounds great, but it's actually usually due to a very unhealthy economy.
We experienced that. It's probably other things going
Correct.
on causing prices to go down.
And that
Not
is
a good thing.
that is not at all a fear of what we are experiencing in the current 2021 world. So we're not going to really talk much about that today. We'll leave that for a later topic. And hey, it may happen one day, so we'll be able to talk about it in real life. But right now, we're talking about inflation. So let's talk about some metrics, because I'm a nerdy kind of numbers guy, right?
I like numbers.
So inflation metrics. And I will point out that these are viewed both like month over month and year over year. So you compare an increase versus last month, or you compare an increase versus last year at the same time. And they're also actually generally published as like a number pegged to a point in time back in the day.
Okay.
And
so the actual inflation number, it's a ongoing moving.
Correct.
It had a starting point and it moves.
But everyone
then
really
they
looks
translate
at
to a percentage.
Now everyone looks at the percent, but there is an underlying number that forms that percent.
Interesting.
So first up is the Consumer Price Index.
All right.
And the Consumer Price Index,
CPI.
So yeah, you hear CPI on the news or whatever. Consumer Price Index. Think that.
That's
was
the those shows where there's a crime and then they go there and they solve it with all the forensic
Is that still
stuff.
going on?
I'm sure.
Because they had like 7 spin-offs of CSI. Different towns. Every town, like Finley CSI, that was a show, I'm sure, because every single town had one.
Big or small, it didn't matter.
It didn't even matter. So,
Cow tipping. Who did it?
Who done it? So that was established. CPI is established by the Bureau of Labor Statistics, also known as the BLS. And this measure of inflation is calculated by establishing the price of a basket of goods, kind of like we talked about earlier, and services, with various weightings that represent what an average consumer spends in a given month. So this includes food, gas, housing, healthcare, et cetera, et cetera. And it's viewed as the cost to consumers. Notably, it excludes any costs that the consumer does not pay. So certain benefits that a employer would pay that technically are assigned to that consumer are not included in this, and we'll talk about that in a little bit. So as prices for these goods increase, the index level increases, and then that shows a percentage change in the cost of living, and this is the preferred inflation gauge for most people, most businesses, and most entities. It's very widely available. It's very utilized.
It's a basket of goods. In a sense, if let's say they said, "Hey, Josh, Rob, we're going to use you as a way of seeing what inflation is. When you go to the store each month, just give me your total, your little receipt of everything you're buying, and gas station, everywhere you go, and then we'll see how much it changes month to month, because you're a very consistent person. You buy the same things all the time, because it's just this basket of stuff.
Yeah.
Every month.
Yeah, so it's going to have, hey, this is how much you spend on your house. This is how much you spend on your groceries. This is how much you spend on fuel and healthcare and utilities and yada, yada.
Everything.
Those are all in there. So there's 2 subcategories of CPI. Mm-hmm. And there's actually 2 ways to look at inflation in general. And those are headline. Mm-hmm. And headline inflation is the one way of viewing it that takes into consideration all of the price changes for all of the baskets or all of the goods in the basket of goods in the calculation. So everything goes in. Nothing's excluded. Another one, and more commonly used in terms of smoothing out some of those big swings, is what's called core. And core takes out what's generally most volatile, and that is food. Food costs go up, food costs go down. They're related to commodities, right? Mm-hmm. Same with energy. So whether that be fuel or utility costs, some of those utility costs are that way as well. Okay, those can go up and down regardless of the rest of the goods. So if you strip out those, you get a lot less volatility, and that would be what's called core CPI in this case.
And that's how they say it. So like if they're talking about inflation, they may say core CPI or headline CPI. Correct. And that's when you know what they're talking about.
Exactly.
So core is without food and energy. Headline is everything.
Yes.
Gotcha.
So on the flip side, another way to look at this is what's called personal consumption expenditures.
PCE.
It is PCE, yes. So this index is calculated by the Bureau of Economic Analysis, and it is similar in many ways to CPI, but it does not, but it does track. Thanks for correcting myself there, because it's a key differentiator.
Very important.
It does track expenditures made on behalf of consumers by employers. Mm. So there are also various weighting and formula differences that go in that are a little bit different, but mainly the expenditures made on behalf of the consumers by employers is what causes a material difference in CPI versus PCE. Because on paper, you'd think they should be the same, right? They're not the same.
It's a different basket of goods.
It's a little bit different basket of goods, a little different weighting, and obviously the employer piece of that is it changes things significantly there. They do generally move in the same direction, but not to the same magnitude and not always at the exact same time. But I will note that this is the most... So I said pretty much everyone uses CPI.
Yep.
CPI is the generally accepted inflation term, but ironically, the group of people that care about inflation more than anyone in the world is the Federal Reserve, and they use PCE.
This. You know why?
Well, there's a lot of reasons why. Do you have a joke about it?
No, I just, in general, they just want to make things difficult. Right?
Well, it's a government entity.
Like, hey, you know what? Everybody agrees to this.
Yeah, CPI
Let's
is
go
great.
The other route.
Yeah.
What's this? The rest of the world use metric system? Guess what? No, we're not.
No.
That's what we do here.
It's like that's why we still use the normal inches and feet.
Normal. You call it normal.
Yeah.
We're the only.
The rest of the world uses metric system.
Metric, and we're like, we'll do the imperial system.
If we really had our act together, we'd be metric by now. So anyway,
it's a whole nother topic.
That's a whole other topic for another day. I will also point out this is also used in both headline and core versions.
They do the same thing.
They do the same split, and they take out food and energy for their core as well. And what the Fed uses to base policy changes is generally core.
Yeah. And the main reason they do that is it's less volatile because the PCE tends to not have as much swings.
Right.
So, I was kind of joking. They just like make things difficult. But they want a smoother metric because if they're making policy decisions, they don't want, like we saw this month, and we'll get to it, but there was a big jump in inflation. It's up to like 4.2%. That's a big jump.
That was headline. Yeah.
And that's a big move. And if they're making policy decisions, you go from, 1.8 to 4.2 or whatever it was. That's a big move,
right.
And you want something a little smoother to make those longer-term policy decisions from.
So I want to get a little bit more nerdy.
Oh, man.
Because this is just what I feel like doing today, Josh. So let's talk about some historical periods in general and how inflation impacted stocks and bonds, okay? So I have a number of different scenarios that we'll talk through, but I also wanted to point out that the highest inflation on record, but take it with a grain of salt because data was really hard to come by back then, was in 1778, 2 years after America was founded.
Yes.
It was reported to be an increase of 29.78% year over year. So about 30% increase in inflation in 1 year. And then CPI data that we had just talked about, that started becoming readily available in 1913. And since that, which is a little over 100 years, the highest that we saw was 19.66% in 1917. Wow. It's also good to point out that there were several periods of double-digit inflation from the founding of our country all the way up to 1913, and it was in 1913 that the Federal Reserve was created with one of their pillars as a goal to moderate inflation. The other is full employment. But that's not really what we're talking about today. They do kind of interact and work together, but that is their two mandates there. So, yeah, it's crazy. Those numbers, like,
can you imagine? 20%?
Really, your dollar is 30% weaker.
Yeah,
that donut would cost $1.30.
Yeah.
In 1 year, you would cut back on donuts. No, you would not cut back on donuts.
Not.
You'd cut back on
clothes
or something, like sell your house.
I would go barefoot to eat my donut.
Crocs are pretty much barefoot, Josh.
Oh, they're the best.
Their stock is the best.
Apparently.
That's not a recommendation, by the way. That's just looking at their chart.
Noting that they moved the positive direction.
Yeah, exactly.
It's because they're coming back in style.
Josh, they were never in style.
They were never left out of style.
Oh, man. Let's just leave that.
You got two modes. You got casual mode and engaged mode.
It's the mullet of shoes.
Man, they're so nice. You don't even know.
So, okay, time period numbers. Noting that these are not annualized numbers. These are
the total
time period numbers over the time period that I refer to. Okay. So from 1976 to 1979, we were in the middle of an oil crisis. Lots going on in the country. Inflation, so we're using CPI here, and we're using the index of CPI, so not percentage change, the actual index. So CPI, inflation, increased 28% over that 3-year period.
Wow.
28%. That's a lot in 3 years.
Yep.
Stocks over the same time, and we're using the price return of the S&P 500, they were up 20% over that same time period. And bonds, so we're using the U.S. aggregate bond index over that time, it was up 21%.
Okay.
So really high inflation,
but the
market
suit with
seemed to be relatively moving in the same direction. But with inflation being that high, yeah, you got kind of the same returns across the board.
Yep.
Not too different. So let's look at the 80s. The 80s were a period of
decade.
Good economic growth.
Yep.
A period where Josh was born.
Yep.
Good times.
Just me.
There was still substantial inflation, right?
Yeah.
Still substantial inflation.
A decade. We're looking at
a whole decade, and during the 80s, inflation totaled 64%.
Seems high.
So from 12/31/1979 to 12/31/1989, your dollar devalued by 64%, essentially.
Okay.
However, stocks over the same time period returned 227%.
Wow.
So your stocks not only kept up with inflation, but they destroyed it. Bonds, now this is a period where inflation was higher, interest rates were a lot higher. Bonds,
but moving
down. Yeah, so interest rates moving down sends bonds up.
Yep.
Due to the relationship they have there. Bonds returned 223%.
Wow. So really,
in the decade.
Between the two,
about the same.
You didn't get much for the increased volatility of stocks during that decade.
Correct.
Bonds returned about the same, and when you look at their yield or their return based on the risk you're taking, they actually probably had a better Sharpe ratio or return.
The volatility was a lot lower.
So crazy.
Now, this was a time when everyone was really happy to be in a 60-40 portfolio, right?
Yeah, you're getting return on both of your
Everything's doing great all the time. So let's flip forward to the 90s, my favorite decade.
Good time for you.
My favorite decade.
Austin was born
These were some
90s.
Great times. Really early.
Early 90s, sure.
So inflation throughout the 90s cooled quite a bit.
Okay.
Inflation only was 33% for the
whole
entire
decade. Yep.
So that's half of what it was in the 80s. People were less excited because Josh was already born and he was a kid getting into trouble.
Double digits.
Yep. So, inflation only 33%. Stocks, on the other hand, rocketed. Through the end of 1999, the S&P 500 was up 346%. Now, towards the end of that decade, we were in the beginning, the dot-com bubble.
Yep.
But they had done very, very well. Bonds only returned 112% during that time.
That's still pretty good.
And a lot of that is pretty good, but you will note that the trend is not working in bonds' favor in terms of total return because we've been on a long-term interest rate decrease really since the 70s. 70s and 80s.
We've really had a 40-year
bond, Bonds have not been going the right way in terms of interest rates. And that's a lot of that's due to economic growth changes, assumptions for the country, and stuff like that. So, flip forward to, we're going to go a little bit shorter period here.
Okay.
2000, so 12/31/99 through 07. Okay. So I'm conveniently stopping it in 07.
Right.
This is the tech bubble. This is the subsequent recovery after that, leading up to, but not going into yet, the global financial crisis. Right. So inflation over that 7-year period was 25% total cumulative.
So it seems a little higher than the 90s because the total was 33.
And that's a shorter time period.
Yeah, that's what I'm saying. So probably a little higher average, but yeah.
Stocks, because of that tech bubble bursting in the early 2000s, for that 7-year period had returned negative 1%. Now, that is price return only. They were positive with dividends.
About break even then.
Bonds, on the other hand, were up 66%.
Volatility. A lot of times bonds tend to do better.
Bonds do better during volatility. Yep. Interest rates also continued to come down as the economy weakened during that time. All right, so let's look at what everyone is thinking about. The global financial crisis, 2008 to 2010. So you're kind of getting the beginning and then right into the recovery, but not that far into it. Inflation was only 4% for that really 3-ish year period.
So pretty low.
Total. So like nothing. 1% a year-ish.
Yeah, very low.
Stocks were down 14% over the time period. Now, there was a huge sell-off in the middle, but that captures most of it. Bonds were up 19%. Rates continued to drop, which meant bonds did well again.
Yep.
Okay? So, 2011 to 2019, conveniently stopping that at 2019. Mm-hmm. Inflation.
Something happened in 2020?
We'll get there.
Okay.
Don't burst. No. Don't ruin anyone's assumptions yet.
Okay.
We don't know what happened in 2020. 2011 to 2019, inflation totaled 17 total percent. It's kind of weak for about a decade. That's a whole decade, only 17%. Stocks were up 157%. That's a lot.
Yep.
Bonds were up, but they were only up 36%, and rates continued to decline. Is really what caused that. Mm-hmm. Okay. Until the end of that, when the Fed started hiking towards the end. So then 2020 happened. There was kind of a pandemic. We're kind of on the edge of that coming out now. Yep. 2020 happened. So let's look at 2020 through to today. Inflation has only been about a year and change. 4%. So it's a little high, but
Yeah.
that's 4%. One-ish year. Stocks have returned 29%.
Not bad.
And bonds have returned 5%.
Not much.
So let's talk about what we can kind of learn from this. So when inflation is high, people are less optimistic about the future of the economy, and therefore they buy bonds because they're less risky than stocks. So this sends bond prices up and stocks down because they're selling stocks to buy bonds. Or at least bonds would be up more than stocks, or stocks would be up less than bonds. When inflation is low, people tend to buy stocks and sell bonds, which makes stocks tend to outperform. And we've been, I guess, probably in an overarching note, in a really low inflation environment since really like the mid-'80s, but really since the 90s, we've seen hardly any measurable inflation. So consequently, interest rates have continued to be low and have gone generally lower throughout that whole 40-year-ish period. And as we've talked about before, low rates are also more favorable for stocks than bonds, and that's been a tailwind for stocks. That's why stocks have done a lot more outperforming in the last 20 years than they did the periods before that.
All right, so that's a lot of statistics.
True.
The long-term average is just under 3.5% if we go farther back to World War II. You're averaging about 3.5%, just under, but about 3.5% per year. That includes the highs and the lows. We've talked about kind of what the Fed's trying to do. So is inflation good or bad, right? I think you and I kind of have our thoughts on that. I'll start so inflation is good in that it's the growth of our economy, right? When prices are going up, it's a symbol or a result of the growth of our economic overall stability and improvement, increasing. If we get better at things and we have more, that's where inflation comes in.
People are making more money and spending more money, and yep.
So inflation in and of itself is not an evil thing, right? It's just the end result of growth. And so for a good, healthy economy, you should see some inflation, right? High inflation, not so good.
Right.
Deflation, not so good. But inflation in general is a result of a growing economy.
Yeah, I think that if you think about the long-term average of our economy, the growth of it, I think now that we're a more mature economy, it's roughly in the 3-ish% range. Yep. If you're in the inflation range of that, you're probably at a really healthy clip.
With it.
A healthy clip.
Yeah.
You can. It's not too out of way either way. The Fed has a mandate. Now they've just recently revised it, but they want to see an average over a period of time.
Which they won't tell you what the period of time is.
They can adjust it however it fits their mandate at that time. They want to see an average of about 2% of core PCE. So taking out food and energy.
Rewind back when Austin explained what core PCE is.
Exactly. So
that's the more stable, and it's excluding food and energy because they're looking at a very stable. Correct. They want to see that average 2%. Okay.
So that's what the Fed wants to see. They will let inflation run hot to bring up the average because we've ran cool below that for a long time.
For a while.
So they will let it run hot above that until the average gets to there. Then they'll start thinking about tapering off bond purchases and increasing interest rates. But that's how they're going to slow growth and slow inflation. And that's really the lever that they pull. Mm-hmm. Two levers, really. Also good to know that inflation is actually, some level of inflation, good for the government. People will then pay more in taxes because they're earning more money. They're going to pay more in taxes locally and statewide because of sales tax being up because inflation's taking hold. And that takes some pressure off of the debt, the interest payments on debt for a government, whether that be a state, a local, or the federal government. Now, that really only works if you keep your spending relatively in line. However, that on either side of the aisle really has not been the case in a long, long time.
Yeah. So to explain that, so let's put in like our terms, right? So let's say I make $100,000 a year. That's my income.
Yeah.
Okay. And I have debt of $130,000 because I use those two for a reason because our debt to GDP as a nation is about 130% of what we bring in each year. So, but it's really easy to understand if you think of it this way. So I earn $100,000 a year. That's my income. I make $100,000 a year. I owe $130,000 a year. If I'm able to keep my debt the same, so I pay my interest, but I don't pay anything off. If because I work hard, I get an increase in salary, and I move, and oh, great! Now a couple of years down the road, I'm making $150,000 a year, and my debt has stayed the same at $130,000. It's less of a burden for me.
Yes,
like you said, that's what inflation does. Is I increased my income, and so my burden, my debt load became less.
Yes.
As long as I keep it constant.
Right.
Now, if I make $100,000 and my debt's $130,000, and then 5 years down the road I make $150,000 and my debt's $200,000.
Right.
The inflation didn't help me at all
exactly.
because I increased the spending as well. So
which
that's
is
what
kind
you're
of,
talking
and
about.
that's kind of the modern monetary theory. Another episode plug someday.
Yeah.
That's kind of the world we live in right now, where we're obviously increasing federal spending and debt, therefore more than we're increasing taxes. So inflation will we see a period of inflation. It will help.
Yeah.
It will not. The gap will not close unless the spending comes down as well.
And that we saw that coming out of World War II. We had a very high debt burden after World War II. So coming out of World War II, we saw a very robust economy, which enabled us to grow out of that heavy debt burden, which was huge. I mean, it helped us out, and there was a lot, because we had the Great Depression before World War II.
Yes.
And so there was a worry that after the war ended, which boosted all of our spending.
Yes.
When that went away, we'd fall back into the Great Depression, but we didn't because the economy grew out of it.
Yeah, our debt to GDP level was the record it had ever been in World War II until now. There's not even a war. Oh, so interesting. That's a topic for another day. So let's talk about what's going on now.
Okay.
Josh.
What is going on now?
A lot. Let's just say that. Yes. But when it comes to inflation, there are a lot of things driving inflation. So we've had trillions of dollars of fiscal stimulus, and whether that be potential infrastructure spending, direct payments to people, payroll protection, yada, yada, yada. We've had episodes about all of that stuff in the past, but trillions of dollars out there that weren't out there before.
Yep.
Super, 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 super easy monetary policy. So the Federal Reserve has interest rates at 0, and they're buying a bunch of bonds in the fixed income market, really putting a lot of liquidity and cash out there. So there are a lot of things that are moving towards increasing inflation because of the dollars that are out there. More dollars means more inflation.
Yeah, more spending,
exactly.
More demand, less supply. Prices go up.
Right.
Prices go up means inflation.
So let's look at numbers.
Yes.
In April, which is the number everyone's talking about. April, we had core. This is the core. This is not headline. Core CPI was 2.96% year over year, so about 3%. For a core number, that's really high.
Yes.
For a headline number, it was like 4 and change. Core PCE was 1.83%, and I think that lags about a month or so. So that'll probably pick up again year over year. So I think it's good to know that we can take those numbers with a grain of salt as well, because those numbers are comparing April to April 2020, which was the
was rough.
bottom of the economic shutdown and everything. So those numbers, the Federal Reserve keeps using the word transitory when it comes to inflation, and they are insisting through this point that that big spike we saw in April, and we're probably going to see some in May and June and maybe even July. Those bigger few-month numbers are really just right-sizing some of the numbers that were really low last year. We're kind of making up some ground, and it's not necessarily new inflation. It's just making up ground. So as long as inflation remains, quote-unquote, transitory, the Federal Reserve is going to be happy to let it roll as long as that average does not get above that 2% core PCE target.
Now, Austin, you got really excited about this topic for whatever reason. I don't even know. You got so excited, we just blew right through my dad joke.
Oh, man.
I mean, we haven't had a dad joke, and you've been rattling on about inflation.
I know.
And so let me give you a dad joke.
That's good.
Right now. And it's more of a comment, a thought, just for you to
think
about. All right. First time, and you probably can think back to your first time for this as well. First time I held a universal remote.
Ooh.
I thought, this changes everything.
That's
good. Universal remote. It literally changes everything.
We have a TV that's probably, it's a smart TV, but it's old now. It's like one of the first smart TVs. And the apps are getting laggy and slow and yada yada. So we ordered a new Apple TV, because we're Apple people. Apparently, just plugging it in via HDMI to the TV, you can use the Apple TV remote to turn the TV on.
Oh, nice.
Like,
you don't have to like type in the code or anything.
Well, you might, maybe you do, but at some point, at some point, you're going to be able to do that, and I'm pretty excited about it.
Well, so we have an Amazon Fire Stick.
Yep.
And I can use that for my TV and my volume.
See, ours, we have the first gen Fire Stick, and it does not.
No, it does not.
Now, that's why we're trying to consolidate. We've got apps on the TV, Fire Stick, my N64. That has nothing to do with the Apple TV, but I have an N64, so it's awesome.
Yes.
But you have to have an adapter for that.
Yeah,
sidebar.
It's so old.
That's right. I love it. So, okay, that was a really good point, Josh. Yes. Changes everything.
It does.
And when you have that remote in your hand, you just feel like
you're in control.
You have control.
That's right.
So wrap it up. Give us some closing thoughts on inflation, where we're at, and what this means for investors and people planning their financial future.
Yeah.
Is it something to be freaked out about?
No, but it's something to be aware of. Because why does this matter for a financial plan? Is when you're thinking about retirement, think about future, you have to assume some sort of growth. So again, going back to if I earn $100,000 this year, and let's say I spend of that, when taxes and everything take out, I'm spending $70,000 of that, right? I need to inflate that forward to say, what will I need when I retire? I need to move that number up to a higher and future number because we know there is some form of inflation. So what number we use matters. So again, we've averaged, 2% or less over the last 10 years or so, like we just were talking about. Well, what we're going to do in the future? What if it's higher? Mm-hmm. And so planning does matter. So yes, you need to be aware of what inflation is. You need to use very conservative numbers, and conservative in this case means higher inflation numbers.
Right.
You need to assume that maybe it'll be higher in the future, kind of what the Fed has talked about. That's what matters. Is it a panic, freak out? No. It'll be in the news a lot. They'll be talking about it. We are aware that when you dump in trillions of dollars into an economy, it will cause some form of inflation.
Yep.
Because there's a lot of money moving around, just like Austin was talking about. But for an investor, stocks, we saw different time periods. Stocks tend to do well, regardless of what inflation is there, right? It's other factors. The 2000, it wasn't because inflation was high. It was because we had a dot-com bubble, right? Yep. 2008, 2009, it was because of global financial crisis. Inflation was muted at that point. Inflation doesn't necessarily have a bad meaning for the stock market, but it will impact because companies, their prices will change, their earnings will change. It will have an impact, but it doesn't just mean, oh, great, now my whole financial plan is ruined. It just means I need to be very cautious of what number I'm using for future expectations.
So let's put it this way, Josh.
Yes.
Say we get a period of a little bit higher inflation. Mm-hmm. Should I buy stocks?
Yes.
Should I buy bonds?
Sure, if your portfolio needs it.
That is the great answer.
Yeah.
In moderation.
Yeah.
Or something. Yeah. If your asset allocation should have this built in. Yeah. You should be planning for this sort of thing anyway.
Yep.
And historically speaking, both asset classes have served their purpose through both inflationary and deflationary environments.
Yep. And really, we talk about this a lot, and we've talked about it in the past. There's a difference between your return on your portfolio and your real return. Real return is what you got minus inflation. And so if I got a 7% return and inflation is 2%, my real return is 5%. In other words, I earn 5% after you account for the increase on what it cost me to buy those things. And so that's the number that matters more than anything is what do I need to do after inflation? Because what we've seen historically is if inflation's at 3%, well, I may get a higher return because the market tends to be fine with growth. We're not talking extreme inflations, but I may get 8%. So I'm still netting the exact same amount from 7 and 2, 8 and 3, they're both 5% real return. So returns matter, but they don't matter as much when you factor in that if I can keep the same real return regardless of inflation, I'm on track. And that's, there's a lot of planning that goes into the whole retirement plan, but the concept is, what do I need to do regardless of inflation to get to my end result? And that's the number you should target.
Absolutely. So, yeah, that's inflation in a nutshell. This is not the exhaustive discussion on inflation. This is extremely high level, but hopefully it will give you...
Now, listening, you may be exhausted. But
I'm exhausted. There's a lot of talking.
That's good.
But hopefully this will give you some peace at just work. Talk to your advisor if you have questions. Mm-hmm. This is what they're for. So give that a thought. And now...
Yes, brand new.
We want to put a special plug out there for an upcoming our second annual The Invested Dads Stock Draft, which will run from late June through Christmas. So stay tuned in upcoming episodes for more details on how you can join us in participating in this in some way, shape, or form. We're working that out right now. But for now, be thinking of the companies that you want to, air quotes on a podcast, own, fake money probably, for the end of this year. So stay tuned for that.
So it was really last year, for those that maybe didn't listen, in June
you just want to rub it in?
Yes, I'm going to remind everybody what happened. No, in June last year, we each picked 10 stocks.
Yes.
And they had to be different sectors, different parts of the overall economy, one per each one. We each held 10 stocks. They weren't real. It was all fictitious.
They're real stocks.
They're real stocks, but we didn't have any real money involved. No. But we saw it from the end of June through the end of December. We looked at performance. And the whole point of that was just to talk through active investing and all the fun stuff we do here. But this year, we'd like to have listeners join in, and we're looking on a way that you could choose your own 10-stock portfolio and, try to beat the Invested Dads.
Yeah.
So it should be fun this year.
So, Josh, how can people help us grow this podcast?
Yeah. Make sure that you subscribe. That way, every Thursday, you get our most recent episode sent directly to whatever podcast listening device you do. Leave us a review on Apple Podcast if you use that. It's a great way to help us rank higher so that more people will see our podcast. And then finally, if you have an idea or a question about inflation, please shoot us an email at hello@theinvesteddads.com. And then finally, if you know somebody who was asking about inflation, you think this would be helpful, make sure you share that episode with them.
All right. Well, until next Thursday, have a great week.
All right. Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.